Hello and welcome to Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICI Director. Welcome, Pankaj, and thank you for taking out time in such a busy schedule.
Hi, good afternoon.
Pankaj, US banking turmoil hits the equity markets globally, raising concerns that all is not well at all. Nifty slipped below 17,000 mark, 200-day moving average breached on the lower side. Banks got hammered. How much more downside do you see for the markets?
Well, Geetu, very difficult to say how this entire banking crisis in US and Europe could sort of pan out. But what we have seen this week is that Nifty has declined about 2 odd percent, largely triggered by the concerns, especially the financial stress in US banks, including European banks. So there we have seen a cut off even more at 3.5% for European banks. Historically, we have seen that this kind of a volatility is very painful episode for equity markets, be it there or be it domestically. But and we have seen whenever these kinds of challenges come in, typically markets would see a correction of say 12, 13 odd percent. I mean, when you look at even the CAD crisis, or when you had Demon, or whether you look at the US elections, so we are already down about 10 odd percent from the Nifty from the highs. So our sense is that or a major takeaway is that typically market has the tendency to form bottoms in these periods of high volatility. And subsequent to that, if people are sort of investing in these kind of a turbulent times, usually the rewarding period, usually the market also rewards. I mean, we have seen that when the Asian currency crisis happened in 96, 97, the market had sort of gone up to make a new high in the period of 3 to 6 months. So this kind of a volatility usually makes a durable bottom, and that is what we are sort of looking for. But I think the volatility is here to stay for some period of time, because we have seen ECB hiking rates by 50 bips. Fed is likely to hike by, say, 25 bips. But I think good part is that now they are also realizing, and which is why when you sort of look at last 1 week, the Fed has expanded its balance sheet by $300 billion. When they were in a quantitative tightening mode. So I think that is a thing of a past. And with this kind of a liquidity support, probably we may not see the kind of turbulence what we have seen this week going into next week.
Pankaj, many of the investors are worried because their portfolios are down by 70-80% now. Can we say that this is still a sell on rise market, or this is the best time to really accumulate quality stocks in the portfolio?
So like I highlighted, see, in this period of volatility, the market has the tendency to sort of make bottoms. And typically when these bottoms are made, next 3 to 6 months market does give the better returns. So I think Indian investors, we have seen historically that the kind of SIP inflows or the overall net inflows, what we have seen is that whenever the market has been sort of making bottom, we have seen higher inflows. And Feb also has been that particular month. So our sense is that investors are a lot more mature compared to sort of dealing with the volatility, especially globally. And domestically, we are not seeing that kind of a challenge, especially when you look at banks. So our sense is that it could be the risk reward is quite favorable for the next 12 months. But yes, volatility is still sort of there. So I think people need to sort of take that into account. But our sense is that overall, from levels like say 16,800 on a higher side, on a lower side, and 17,500 on a higher side. So unless 17,500 does not get taken out, I think we may not see a meaningful bounce, and we might continue to sort of remain volatile. So it's a event to be sort of watched for. But I think at the same time, this is not one of the events where people should sort of shy away from the markets as well.
US banking outlook has turned negative. First, we had SVB, then we had Credit Suisse going, the way the SVB was. But yes, central bankers came and supported the banks in terms of putting in money and saving the depositors' amount. But The kind of rub off that we have seen on the banking space in India is not justified, Pankaj, because our banks in India are well regulated. They have so many, obligations put in by RBI to really meet the capital adequacy ratio, the CRR, SLR. So this kind of a rub off that we have seen, hammering that we have seen in the banking space, how would you justify it?
So one is it is wrong to say that will not be impacted. I think the only impact what we see is more of a sentimental impact on Indian banks. We have seen Indian banking index sort of correcting 3.5% more than Nifty, and largely because when you even look at the from the FI inflow perspective, while there is an inflow of about 15,000 odd crores, of
Mm-hmm.
that the bulk deal is about 20,000 odd crores. So obviously there is some bit of a selling which has happened, and typically a selling happens in IT and banking stocks. So yes, there is going to be a sentimental impact. Now in US, the challenge is that with the kind of names which have sort of come out, it is possible that some of these smaller regional banks might sort of not really go aggressive in terms of credit growth because you would want to sort of conserve capital, and that would imply that probably from soft landing, US might experience a hard landing unless Fed does something about it.
Mm-hmm.
So from that perspective, things are going to sort of remain challenging for banking. But
Okay.
like I said, I mean, while we have seen 3.5% kind of a correction, when you sort of look at domestically, we don't really expect mark-to-market losses for banks, even though the RBI has hiked rate by 250 odd bips, because most of the banks have already sort of provisioned for. And I think when you look at the Indian banks' exposure to global, I think it's about 5% of their advances, and these advances are again to Indian companies operating there. So from that perspective, we don't see a challenge on the balance sheet or a diminution in the value of investments. It is
Mm-hmm.
more of a sentimental impact is what we are going to see. And I think given the cut what we have seen, I think tier one banks, see, typically in this kinds of volatility, there is a flight towards safety, and which is why large caps get preferred. So even within
Mm-hmm.
banks, I think probably this is a time to sort of look at larger banks, say for example SBI, where target price is 700. Now this company is guiding for bank is guiding for 14 to 16% kind of a growth, and earning growth is expected to be 24%, ROA of 1%. Similarly, Axis Bank also has seen a decent sort of a correction. So here earning growth is expected to be 29%. It's trading at
Mm-hmm.
about 1.6 time, and overall number of growth looks quite good. That they're guiding for 5% kind of a growth above the industry growth rate. So here our
Mm-hmm.
target price is 1100. So probably in this volatility, tier one banks could find favor because whenever the market bounces back, I think these are the banks which are probably going to lead the recovery.
Mm-hmm. Pankaj, one sector which is really holding up is oil and gas space because crude falling below $75 per barrel is a good news for Indian economy also. But overall, sentiments are weak, but this sector is holding up. Your BPCL, HPCL, IOC are doing well. Reliance got a beating. It was hammered because their refining margins may get hit. What to do in this sector now? What do you like the most as far as the oil and gas stocks are concerned?
So we have seen about 14% kind of a decline in crude oil prices in the last fortnight, so from about $86 to say $74. Actually, the prices have dipped closer to about below $70 also in for a brief period of time. Now, obviously,
Mm-hmm.
this is good news for a lot of sectors, including the oil marketing companies. Now, when you
Mm-hmm.
sort of look at oil marketing companies, they were sort of making losses on the marketing side. Refining is obviously, like you highlighted, is under challenge. But with
Mm-hmm.
decline in crude oil prices, our sense is that the refining margins, marketing margins for some of these companies will sort of do well. And which is why
Mm-hmm.
I feel that in a near to medium term, these stocks have the potential to do better. I mean, HPCL, when you sort of look at, has got the highest marketing exposure, then
Mm-hmm.
followed by BPCL and IOC, and which is why I feel that HPCL is trading at about 5 times P multiple. They're looking for expanding their capacity to about 15 million tons and another refinery in Rajasthan. So from that perspective, this stock looks good. Similarly, for BPCL, it's trading at about 6 times. and has set a capital outlay of about 1.4 lakh crores over the next 4 5 years. So this also looks good.
Mhm.
Risk reward looks quite good, and same is the case with IOC. Probably IOC we haven't seen that kind of a bounce, but our sense
Mhm.
is that this stock is also trading at about 6 kind of a multiple. So with a target price of 90. So from that perspective, all the three marketing oil marketing companies are looking good and could witness a temporary or near-term or medium-term bounce from current levels,
Mhm.
given the fact that now you are seeing a relief on the crude. And mind you, it is
Mhm.
possible that the government may not really sort of put additional duties because they had cut the excise duties earlier to sort of lower the prices.
Right.
In fact, it could be a good news for even government as well.
Mhm. And the decline in crude prices also benefits sectors like paints, where it's a crucial input for FMCG companies, where the oil prices coming down would really impact positively their margins. How do you see these sectors, and which stocks would you prefer?
So, like you said, auto is another sector which should be a beneficiary of decline in crude oil prices. So, one is we have already seen in the last quarter, auto companies are reporting margin expansion of 50 to 300 bips. Now, we know that the crude oil prices have declined. So, obviously, a lot of these crude based derivative products also will sort of come down. And we've
Mhm.
seen non-ferrous metal prices also sort of correcting because now the fear is that probably US might experience a hard landing. And
True.
largely the beneficiaries are typically OEMs first and then ancillaries later. So which is why I feel that a company like Maruti Suzuki with 11,200 kind of a target price, Tata Motors with 530 kind of a target price, and Motherson Sumi Wiring with a target price of 75. I think these companies could be beneficiary. Now,
Mhm.
in FMCG, if you look at, so FMCG is one sector which has been sort of struggling for some time in terms of
True.
the growth, especially on the rural side.
Mhm.
And largely because the inflation was higher and they had taken a good aggressive price hike. With a decline in sort of crude oil prices, it is possible that most of the companies will benefit and their raw material cost compared to sort of their top line would sort of come down. And that would sort of give them leeway to either increase the grammage or probably do more of a higher ad spend. And that could possibly revive the volume growth for FMCG companies. And
Okay.
notable beneficiaries would be HUL, where our target price is 2,800, and Jyoti Laboratories. So these companies have a higher intensity or towards crude oil prices volatility. So I think these companies should benefit. Now,
Mhm.
when you sort of look at paints, we all know that there is a heightened competition which is going on. We have big players like Grasim announcing bigger capex. So there are senses that while we might see some bit of a expansion of margins to the range of say 60 to 80 odd bips,
Mhm.
but since the competition is higher, so largely most of this benefit is going to be passed on to the end customers. And while when you sort of look at some of the key raw material prices like titanium dioxide is down about 10, 11 odd percent, but benefits are not expected to be retained by most of these companies.
Okay.
Although in terms of preference, it will be more of Asian paints with a target price of 3180 and Berger paints. But I think paint may not be a big beneficiary given the heightened competition.
Mhm. But we saw a very good momentum in Asian paints this week. It has been an outperformer. Let's now talk about one of the sectors which has been performing quite well from last couple of years, and that is defense. We have seen increased orders being placed from the government with all these companies, which particularly the PSCs benefiting. So, how do you see this sector panning out in times when you have so much of uncertainty going out globally?
I think defense is one sector which is largely sort of deriving the benefits from higher indigenization. And
Mhm.
say, for example, we have seen Defense Acquisition Council approving 70,000 worth crore kind of equipment for the
Mhm.
armed forces. And we have seen that most of these companies or most of these orders are going to be sort of indigenous ones. So our sense is that defense is one sector which is really not sort of that perturbed with the kind of volatility what you see globally. And lastly,
Mhm.
because the order pipeline is quite strong, because one is, while the defense budget allocation was hiked by 8 odd percent, but when you look at the higher indigenization level, that's a 19% kind of a growth for the domestic companies in terms of the domestic procurement being higher.
Mhm.
And within that, I think HL is one stock which is looking very good, because they are sitting on an order book of 91,000 odd crores. Order backlog is about 3.5 times trailing 12-month basis. Then our sense is that the numbers for FY25 will be a lot more better, because the deliveries for the crucial Tejas MK1 will start. And then
Mhm.
there are a number of other manufacturing contracts in the offing.
Mhm.
And it's trading at about 16 times forward multiple basis. So I think besides, so this company looks good with a target price of 3,300. Besides that, I think VDL is another company which is looking quite attractive in the defense as
Mhm.
a space. So defense is sort of standing out within most of the sectors as of now.
Mhm. When we talk about volatility in the markets, we talk about some defensive sectors also, and pharma is one of them, which has not performed at all, and not much momentum is yet seen in this space. Can we expect some kind of a bounce back for pharma sector and pharma stocks?
So, like you said, yes, whenever you have seen periods of high volatility, there is a flight towards safety which happens. So, you have typically defensive sectors, IT, pharma, and FMCG. Now, IT derives good chunk of revenues from the BFSI space, and we all know that BFSI space, especially the smaller regional banks or smaller banks in the US, could get challenged. So that is where the outlook is still not very sort of clear. So
Mm-hmm.
from that perspective, FMCG and the domestic pharma or the pharma companies relatively look better. FMCG, I already highlighted. I think on the pharma side, again, it is more of domestic pharma companies which are sort of looking a lot more better.
Mm-hmm.
And because there the expectation is that you will see low double digit kind of a growth rate for the domestic pharmaceutical market, and which has been a sort of a historical sort of growth rate. And then the margins are better for domestic oriented companies. So I think FMCG plus domestic pharma are relatively sort of better. We haven't seen that kind of a price movement, but our
True.
sense is that this is one space where the risk reward is still better.
Mhm. Now it's time for hidden gem. So, which is the stock that we are going to talk about today? I know it's a very difficult times, and selecting a stock is even more difficult.
So I am sort of going by largely a historical book, because or historical reference. Like I said, I mean, in kinds of volatility or the kind of volatility what we are seeing, though it is yet not the kind of volatility we have seen in say previous
Yes.
levels. So it is volatility is still lower, but volatility is still at elevated levels. And in this times, I think it is better to stick with larger cap names and defensive names, and which is why I feel that a company like Dabur looks good. We've seen decent amount of correction in stock. Our target price is 700. This is one of
Mhm.
the largest FMCG companies, and has got a good Ayurveda based product across categories. Then they have been sort of foraying into multiple new categories in the last 2 years, and they have been able to maintain their margins to about 20 odd percent. And I think overall improvement in the rural demand plus the decline in crude oil prices should benefit this company.
Mhm.
And then they are sort of looking at extension of some of their existing brands. So this company looks better with a target price of 700. So I'll sort of again, given the market conditions, I'll stick with a safer name.
So, hidden gem this week is Daba with target price of 700 rupees per share. Uh, Pankaj, next week we have Fed policy, which is really going to determine which direction the markets globally and in India will go. How would you approach the markets?
So, given the fact that there is a risk sentiment sort of going on, or the mindset of the market has changed, because earlier there was only one lever people were looking at. Now you have the banking crisis sort of changing that flavor or changing that mindset. So, Fed meeting is obviously quite important, but we have seen ECB rising or raising rates by 50 bips. So, our sense is that the Fed also might do 25 bips kind of a hike because of the kind of positioning what they have taken. because inflation is still at about 6%, so that hasn't really sort of meaningfully come down to 2%, the levels desired by them. But like I said, since the banks are under crisis, so the one stance what they have already reversed is the quantitative tightening. So they have started providing liquidity to banks, and so I think probably they'll do a hike of 25 bips and probably wait and watch for some period of time how the scenario sort of pans out. But a lot depends on what kind of stance they take and what kind of forward guidance they give in terms of how they would sort of manage the crisis. So, like this week, probably next week is also going to be a volatile week, but probably not of the same intensity what we have seen historically.
Pankaj, thank you so much for being with us and appreciate your time.
Thank you so much. Pleasure interacting.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.